Good show.
Okay. Okay. Now, after the intro, Dex, do I say this is the question and answer section?
No, don't worry about that.
Okay, you just going to go into it?
I'll just,
Okay.
plow through.
All right, here we go. You ready?
I'm ready.
Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. Thank you for joining us on Wall Street versus Main Street. I am your host, Dax White, and we are again going to be trying to shine a light on the tricks of the brokerage industry based on my experience representing investors in FINRA arbitration claims against brokerage firms and some of the things that I've picked up over the years and things that I've seen in the cases that we've handled. Each week we'll take on different topics. I found in our first few episodes we maybe tried to sandwich too much in there and hit too many topics and didn't really get into the quality that I'd like. So we're going to focus now just on, broad stroke, one topic maybe per week, a couple of tips and play it out that way and see how that goes. So this week I want to talk about what's going on in the oil and gas market. Obviously this is something that if you follow the market in any way, you're tracking, you've seen that oil prices have collapsed in the last 6 months to a year, impacting virtually every aspect of the market, but certainly companies that are focused on oil and gas, energy, etc. And we're not going to dive into detail in terms of the impact that might have on your big boys, your Exxons, your Chevrons, your BPs, because that's out there, and I think that information is readily accessible to people. And the reality of the show, again, is that the objective here is not to provide investment advice. I am not a registered professional. I'm a securities attorney. The objective is to focus on where I think we might have financial advisors taking advantage of people based on what's happening in the oil and gas market, based on things that I've seen in previous cases. And in that regard, I see two things that are potentially problematic. The first, which we haven't seen yet, but I still think that it's going to be a problem here in the future, has to do with junk bond cases. Obviously part of the reason for the decline in oil prices has to do with America stepping up. And we've developed the technology for shale drilling, and we now are a huge producer of oil again, capturing an enormous market share and frankly flooding the market with new reserves. The companies that have done that are primarily upstart shale companies who bought drilling rights either in North Dakota or Colorado or Arkansas. There's some in West Virginia, wherever they've found these new deposits that were inaccessible before shale, the technology came out. And these companies have primarily raised money by issuing debt. And that debt is paying an enormous rate because, frankly, these are very aggressive, very high-risk companies. They're hit or miss. Either we're going to drill the well and it's going to work out and it's going to pay great, or we're not. And the only way to incentivize people to want the debt is to pay a very high yield. And that investment might be attractive to certain investors in a very low yield environment. And my concern would be those situations where maybe you've got retired investor whose plan in retirement was, I need a 4% return. That's always been the industry standard. Hey, you can retire comfortably on 4%. But in this low yield environment, that's incredibly difficult to do without risk. And so the question and the discussion with the financial advisor may have been, hey, where can we get some yield? And the concern would be an advisor who says, hey, why don't we buy some debt of these shale companies that are paying 9.5% and 10.5% and very high yields. And obviously there's a correlation between risk and return. But the concern I have, because I've seen it so many times, where maybe that's not a discussion that the broker is having with the investor. Maybe they're saying to him, hey, these are solid, oil, that's always safe. Let's invest in this. And they pays this great yield. Now we've got oil prices have collapsed. There's going to be an incredible difficulty on these companies to repay that debt. Maybe they're still paying now, dipping into reserves. But if prices remain at these levels, I'm concerned that a lot of that debt is going to end up in default. And so it really depends in terms of whether or not we'll see these types of cases. It depends on who bought it. Is it Main Street? I mean, that's the title of the show, Wall Street versus Main Street. Is it Main Street investors who are being sold it by their financial advisor? Because this is how it works in the world. They try to sell institutions first because, frankly, institutional investors are going to invest hundreds of millions of dollars. So if you want to raise $100 million and you only have to go to one person, that's much easier. But if that doesn't work, they move down the line, and the last person they go to is Main Street. The last thing they do is go to brokerage firms and say, hey, we need you to sell our product. And they'll incentivize them to do it. Hey, we know it might be a tough sell. Why don't we increase your commission to do it? And so that's what's unclear to me at this point is who bought that debt. But if it's little old ladies who are retired and needed income for retirement, those were incredibly inappropriate investments, particularly if it's in any kind of high concentration. And so I have concerns that as long as oil prices remain at these levels, that we may see some situations where Main Street investors get burned. One other area where I'm relatively confident there are going to be cases, because we've handled them in the past, have to do with oil and gas limited partnerships. We've seen a number of these cases over the years. These are incredibly high-risk investments. Usually they are sold talking about a track record. Hey, look how great this is done in the past. And there'll be in the fine print there some language that says, prior track record is not indicative of future success, but broker glosses over that and says, look at this huge returns this company's had. The problem is, of course, that, in the past, oil prices were higher than they are now. So if you're buying an oil and gas LP and you bought it 2 years ago when gas prices were north of $100 and they drilled the well, took them about 6 months to a year to get going. Now they're drilling. Every gallon of oil they pull out of the ground, they're losing money on because they've got fixed costs on infrastructure. They were banking on particularly with shale. Shale is more expensive than it is to drill for oil without using that technology. They've got enormous costs involved, and my concern is, we've seen these cases. These types of limited partnerships have been around for a long time. Our clients were buying these in the 2003 to 2008 time period, and those cases are still ongoing. But for the most part, they've played out. What I'm concerned about are the people who bought in 2010, 2012, thinking this is a 5-year investment. But if you bought it when oil was at those levels, it probably looked pretty good. And again, if they were basing it on a prior track record, it could look good. But what we've seen in a number of cases is that brokers gloss over the risks of these types of investments. The sponsors we've seen, and this is not an indictment on those sponsors, but we've seen these products missold by financial advisors. Reef Oil and Gas, Atlas, Mewbourne, Noble Royalties, Ridgewood Energy. These are some of the players in this limited partnership space. And again, these are products that are sold by brokerage firms. They're Regulation D private placements, so they're exempt by the SEC from certain filing requirements. And there's parameters of how they can be sold. You have to have a certain, you got to be an accredited investor generally, so you have to have a certain net worth or certain income. But the problem that we've seen is that most retired Americans are going to qualify, but that doesn't mean that they're necessarily, the reason for accreditation was to establish this baseline of who's going to have the requisite knowledge and investment experience to really be able to evaluate these deals on their own. And when they said, okay, let's make it $1 million back in the 60s, that was a lot of money. If you had $1 million, you probably were really sophisticated. That's no longer the case. We have so many clients, they live in California, 2 teachers making $60,000 a year, but they bought their house 40 years ago. They sold it when they retired, and look, their house is worth $1.2 million, and suddenly they're millionaires. That doesn't mean they can evaluate these types of deals. And that's where the financial advisor comes in. They've got to make sure they're making investment recommendations that are appropriate. And you can't just go off the baseline, oh, you're accredited. Okay, it's suitable for you. You got to make sure that the investment makes sense. So those are some things that I'm concerned about as we see oil prices tanking is who are these investments being sold to? Because if oil prices stay at these levels, I'm concerned that those deals don't work out the way the investors hoped. The other problems with the investments just in general have to do with how they're structured. It's very advantageous to brokerage firms, very high commissions. Again, they got to incentivize the brokerage firm to sell them. And if they're down to the level of Main Street and they can't just go and find another energy company that wants to drill the well, or if we're on the level of, okay, let's go find mom and pop investors, they got to pay these brokers something to sell it. And usually it's on the very high end of the spectrum for these oil and gas limited partnerships. So those are the things I'm concerned. We've got a few questions on point. Cindy, why don't you hit me with the first one, please?
So I bought an oil and gas limited partnership a few years ago. At first it paid great, but now the payments have dropped dramatically. Should I be concerned?
Maybe. Probably yes. Generally speaking, these oil and gas limited partnerships, the payout is it looks like a bell curve. It starts out exceedingly slow. That's while they're drilling the wells, so they're not pumping any gas out of the ground yet, and it's all costs, so they're not paying out anything. Then you see a huge spike as we drill it, hopefully, unless it's a dry well. But now we're drilling the well and we're pumping out gas, and you see a big spike in it, and then eventually it starts to peter out, and that's where the bell curve comes in, because at some point, it'll go to zero, of course, because the well will be dry. So if your investment's already reached that point where it started to peter out, it's not likely to go back up. Once it peters out, that's sort of it, because it's not magic in the ground. If the well's dry, it's dry. Mm-hmm. So yes, that's something that would certainly be a concern. And frankly, the reason we see these things has to do with the costs involved. And again, when you're talking about these types of investments, we're selling to Main Street now. These aren't usually the best wells. The best wells get bought by Exxon and BP, and we've seen it a number of times. I've seen it in arbitration hearings where you're asking, the sponsor of one of these oil and gas companies, why are you doing this deal? And the answer is because of all the money they make, regardless of whether or not the well works out. But it says it right there in the prospectus or the private placement memorandum that, hey, Exxon passed on this deal, but we think with our technology that we can make it work. And to me, that's laughable because, obviously Exxon's the gold standard. If they can't make it work, what makes these smaller oil and gas companies think that they can? And the answer is they don't care. They're going to make money regardless. And unfortunately, the ones that take the lumps are Main Street investors who were relying on a financial advisor that told them, hey, these things have a great track record and they pay great. So yes, if you're in long answer, if your investment stopped paying or it started to peter out, that is definitely a problem. What's our second question?
The second question is, I bought an oil and gas LP because of the income my broker told me that I would get, and because he said it was safe. I read the prospectus, though, and it discloses all kinds of risks, which is right. Maybe they just have to say that.
Yeah, I hear this one a lot, usually at a hearing or at a mediation, where the client says, I read through it, I know it says all sorts of risks in there, but I asked the broker about it, and he said, don't worry about it. That's just some lawyer who has to say that. That's not accurate. These are exceptionally high risk investments, and those risks that are disclosed in the private placement memorandum are in there for a reason. It's because they're very risky investments. There are a number of times where they drill a well and there's no oil. And so if your financial advisor is telling you that, then that is absolutely inaccurate, and you need to ask some follow-up questions and make sure that you guys can get on the same page. Now, every investment has a time and a place. And maybe you're looking for an exceptionally high yield and you're willing to take those risks, and that's fine. But what we're concerned about and where we would typically get involved is where you have an investor who frankly doesn't have the level of sophistication to evaluate the deal. They can't read a private placement memorandum and understand it, and they're relying on the broker. And if your broker's telling you, oh, don't worry about that, it's just boilerplate, that's wrong. So I think that's about all the time we have for questions. If you have a question, please feel free to send us a request to our website at wallstreetvmainstreet.com, and we'll try to get to those in a future episode.
Your eyes are usually the first thing that people notice about your appearance. They are probably the most important aspect of facial attractiveness. Even with a good night's sleep, loose skin over your eyes can make you look tired, sad, or older than you really are. In severe cases, vision can become partially blocked. Come for a consultation with Dr. David O'Brien. Look and see better with the help of New Vision Eye Center. Visit newvisioneyecenter.com or call 772-257-8700. New Vision Eye Center offers bladeless laser cataract surgery. Doctors Paul Minotti and Stephen Tate want you to be fully informed about all of the options available to you when it's time for your cataract surgery. We offer a gentle, bladeless, computer-guided procedure. This technology delivers unsurpassed accuracy and precision. Visit cataractsurgeryverobeach.com or call 257-8700. When it's time for cataract surgery, make the move to the Cataract Institute at New Vision Eye Center in Vero Beach.
Hey, Treasure Coast, need to clear clutter from your house? Want some spare room for your spring remodeling projects? Uncle Bob's has the space you need. Uncle Bob's Self-Storage just opened 2 new stores, one on 20th Street in Vero Beach and another on South Federal Highway in Port St. Lucie. Come celebrate with a special deal. Right now, Uncle Bob's will give you up to 1 month free on your second month of storage. Stop into one of these new locations or visit online at UncleBob's.com. That's UncleBob's.com.
And we are back with Wall Street versus Main Street with your host, Dak White.
Thank you. Welcome back. The second thing I wanted to hit on was to sort of, again, the objective of the show is to provide information so that you've got, try to even the playing field a little bit when you're having dealings with your financial advisor. And I would say 99.9% of the cases that we work on are situations where the financial advisor was maximizing his commissions at the expense of the client. Because the rule, as much as I'd like it to be a fiduciary duty standard where they have to make a recommendation that's in your best interest, the reality is, at least as the law stands right now, their requirement is only to make a recommendation that's suitable for you. And suitability has to do with your income and your investment objectives and your net worth and your investment experience. But the reality is, there can be a whole spectrum of investments that might be suitable for you, but maybe the one that's in your best interest is this low-cost ETF versus this very extremely upfront cost, whatever it is. And so typically when we're involved, that's what happened, is that you've got a financial advisor who, he'll argue the investment was suitable, but what he was really doing is putting his own interest first or her own interest first and recommending a product that was better for them in terms of compensation. So what I thought I'd touch on today was, what are the investments that pay the most, so that you can be on the lookout if your broker is steering almost exclusively to these products. You can say to them, hey, why are we talking about these investments? Why are you only recommending these? What else is there? Because what I have found is that generally speaking, there's always a lower cost alternative. There's great companies like Vanguard who put out low-cost ETFs that pay 0.1%, let's say where they're trying to track the S&P. That cost basis is enormous if your alternative is a mutual fund that's trying to do the same basic thing, but your upfront load is 4%. It is exceedingly difficult, regardless of who the fund manager is, to outperform an S&P ETF with a 0.1% basis versus an upfront load of 4%. They're already 4% behind the 8 ball. So not only do they have to track it, but now they've got to beat the market by 4%, and that's exceedingly difficult for any money manager, particularly consistently. And so that's why cost is so important with these investments. And we've got some resources on our website, Wall Street v. Main Street, that touch on that point, because there's a lot of great studies out there, but you'll find that if you were to track the progress of your portfolio over the history of your life, let's say you're a 30-year-old investor, you're putting aside $10,000 a year. If you look at how your portfolio will perform, if your cost basis is less than 1% versus 2 or 3%, you'll find that the results are enormous. You could have the same performance, let's say it's on average 8%. Same performance, but you could have hundreds of thousands of dollars of difference in terms of where your portfolio will be at the end, 35 years later when it's time to retire, if you've been paying out too much money. So that's why commissions are so significant. That's why it's important to ask the question, because it's easy for an investor to say, oh, well, it's only 50 basis points or 0.5% more. That adds up. Compound interest is a big deal. There's a lot of studies out there that talk about it. But the more you can keep in your pocket and then let that grow, the better. So let's talk about the ones that are exceedingly high commissions. So again, if your broker's consistently pushing these products, that can be a red flag for you. One of the higher commission products is a hedge fund. We're going to talk about those in next week's episode because, again, this is Wall Street v. Main Street. I think hedge funds, there's a time and place for every investment, but hedge funds, it's really tough to justify for Main Street investors, at least in my view. Particularly, again, little, mom and pop retirees, probably have no business in a hedge fund. And part of it has to do with commissions, part of it has to do with evaluating risk, but the commissions are often between 8 and 10% to the sales agent who's getting paid to recommend a particular hedge fund. The next one, and we just talked about these oil and gas limited partnerships, but there's other types. There's equipment leasing funds. There's all manner of types of private placements, but private placements generally pay between 5 and 10%, and it's often on that high end range. So again, that's a huge incentive for the broker versus an ETF that pays 0.1%. I mean, that's the expense ratio. And now you've got a broker who can make between 8 and 10% or 5 and 10%. Next one is non-traded REITs. Non-traded REITs is a real estate investment trust. It's a real estate investment structured similar to a mutual fund, but those things often pay up to 7%. Huge commission. Again, most financial advisors who do the model is in assets under management, and they'll take 1% annually of the assets they're managing. Compare that to a 7% upfront fee. I mean, it's enormous. Next one is variable annuities. That's a high commission product, anywhere between 3 and 7%. It's usually in the 3 to 4% range. There's a time and place for annuities for sure, but the problem I see is when the objective is just to, hey, I want an equities portfolio, and the broker says, okay, well, we can do that in the sub-accounts. Yes, you can, but you could just buy mutual funds, stocks, bonds, equities, ETFs, whatever, without paying the 3 to 7% for an annuity. So with annuities, please make sure there's an insurance component reason why you wanted that, because the commissions are high. Next one, mutual funds, anywhere between 2 and 5%. Usually they're on the lower end. The problem with mutual funds is when they're flipping mutual funds, usually you'll see them recommend one and then a year later recommend another one. That can be problematic, certainly from a commission standpoint, because they're usually upfront load fees, and here they're getting paid again. That upfront load is okay if you're going to hold it for 20 years. You pay it 4% one time, you sit on it, but it's not good if you're flipping them. So that's something to be on the lookout for. Closed-end funds, same sort of range, similar products, same problems. If they're flipping closed-end funds, that's a problem. Managed futures will pay a high percentage. They're also very complex investments, so that those have their own issues. Structured products that brokerage firms will create, principal protected notes, and tracking this index and whatever. I mean, there's a variety of them, but those usually pay the brokerage firms a high percentage. And the last one I've got here, unit investment trusts, also called UITs, and those usually pay upwards of 3%. So those are some of the products. Again, investments, they all have their time and place. And if your broker's saying, hey, I really think this unit investment trust is great for you, and it's 10% of your portfolio, that's probably not a huge red flag. But if every recommendation they're making is one of the ones on this list, that's a red flag. Because those are all the highest commission products, and the question becomes, why? Why are we only getting these recommendations, and why am I not hearing from you on these? And you better like the answers to make sure that you're okay with the recommendations that you're getting. So that's been this week's show of Wall Street versus Main Street. Again, each week we're going to try to shine the light on the brokerage industry and talk about some of the things that we've seen in our experience, things to look out for. Next week's show, we're going to discuss hedge funds, and we've got Peter Phillips coming in. He's a hedge fund professional, having worked for BlackRock and Blackstone. He's going to give his take on, he's usually dealing with institutional investors, but what are the concerns when we're talking about hedge funds for Main Street investors? So if that interests you, please tune in. And if you have questions or you just want some of the information I've talked about, head to our website at wallstreetversusmainstreet.com. Lots of resources there on a lot of the topics we talked about, commissions, and how that impacts the performance of your portfolio, We've also got information on there on modern portfolio theory and a lot of things that would be insignificant when you're talking about your relationship with your broker. You know, ask them those questions, have those resources in front of you, and see what their responses are.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.